While the national conversation focuses on rising debt, the U.S. Treasury is looking at a dormant asset on its balance sheet that hasn't been revalued in over 50 years. This specific accounting loophole is known as the Gold Revaluation Account, or GRA, and it is a mechanism the government can use to bypass the bond market entirely. This is the current gap. On its books, the U.S. values its gold at a 1973 statutory rate of just $42.22 an ounce. That puts the official stockpile at $11 billion. At today's market prices, that same gold is worth roughly $750 billion. To capture this wealth, the Treasury can issue new gold certificates to the Federal Reserve. The Fed then credits the Treasury's checking account for the updated market value, instantly creating hundreds of billions in new spending power without issuing new debt. When this money enters circulation, it expands the monetary base and weakens the purchasing power of the fiat dollar. This specific expansion makes gold a mandatory defensive hedge against the impending devaluation of the currency you hold today. This strategy has a direct historical precedent. In 1934, President Franklin D. Roosevelt used a massive gold revaluation to restructure the American monetary base. However, economists like Dr. O.M.W. Sprigg warned at the time that tinkering with the currency doesn't guarantee stability if the underlying demand for credit is weak. The government pulled this lever again in the early 1970s, moving the gold price to $38 and finally to the current $42. History shows that revaluing gold is a recurring tactic for managing national solvency. But knowing why you should own gold is only the first step. Navigating exactly how to buy it in the current environment is a regulatory minefield. Tax changes scheduled for April 2026 have broken the old conventional wisdom that sovereign gold bonds are always superior to physical gold.
Investors now face a strict financial trilemma. You have to choose which trade-off you can live with: losing yield, losing your ability to sell quickly, or losing your tax efficiency. Let's start with the baseline option: purchasing physical gold coins or bars. This route gives you absolute ownership. Because there is no paper contract involved, you have zero counterparty risk. Physical gold also offers immediate liquidity. You can convert it to cash or use it for jewelry in an emergency, without needing to find a specific buyer on a stock exchange. But the financial downside is clear. As this comparison shows, physical gold generates zero annual yield on deployed capital. You also have to account for making charges, dealer markups, and ongoing costs of secure storage and insurance, which drag down net returns. Physical gold is not a tool for compounding wealth. It is an insurance policy that requires a premium to maintain. The alternative to physical metal is subscribing directly to primary sovereign gold bonds through the central bank. The primary SGB route reverses several physical gold costs. You earn a guaranteed 2.5% annual interest yield, and you pay zero storage fees. Most importantly, this is the only way to avoid capital gains tax entirely upon maturity. The cost of this efficiency is a total lack of flexibility. You are committed to a strict 8-year lockup. If global macro conditions or your personal financial needs change over the next decade, your capital is effectively trapped. Primary SGBs offer the highest theoretical yield, but they demand that you surrender your capital agility. To avoid that 8-year lockup, many investors turn to the secondary market, buying existing SGBs on the stock exchange. This path still yields the 2.5% interest and avoids the overhead of physical storage. But the 2026 rules set a trap. Secondary SGB buyers no longer receive the tax-free maturity benefit. Instead, you are hit with a 12.5% capital gains tax. This tax creates a severe drag on net ROI, drastically reducing the mathematical appeal of the secondary market. Tax-free paper gold trading is effectively over. If you want agility, you must accept a significant financial penalty. Post-2026, the specific vehicle you use to enter the gold market will determine your final wealth as much as the entry price. Macro optimizers seeking generational wealth and tax efficiency choose primary SGBs, accepting the 8-year wait. Agility investors wanting active trading buy secondary SGBs, accepting the 12.5% tax. Tangible traditionalists seeking systemic immunity buy physical gold, accepting zero yield. There is no longer a perfect asset. Every path requires you to accept a specific type of friction. By matching your macro outlook with the correct vehicle today, you can protect your capital from both fiat devaluation and the new regulatory traps.